Elena. Nice to meet you. Elena. Nice to meet you. Nice to meet you.
Good afternoon, everyone. My name is Kieran, and I'm case facilitator this afternoon. Just have a quick few announcements before we get started. First and foremost, welcome to the JDC West 2015 tax case competition. Big thank you to our judges for being here today. Introducing Amanda Galvin from KPMG, Donna Dangerfield, KPMG, Jonathan Helm, Franklin Templeton Investments, Whitey Mitchell, Sterling Financial Accounting Services, Phil Hansing, Ministry of Advanced Education, and Jennifer Figner, PCIT. Competitors have 20 minutes to present. Immediately following your presentations, judges have 5 minutes to ask questions. We have a volunteer timekeeper right there to let you know where you are in your presentation. Please no questions, comments, cell phones, or picture taking from the audience. Please hold your applause until after the questions period is over, and we ask that you exit the room immediately following the question and answer period. Competitors, you may begin when you're ready.
Henry, Susan, it's great to see you again. And we've been working together for a long time, but let us start off by thanking you for giving us this opportunity to work with you again. We are so excited to hear about your plans to hand off the business, pass the torch off to Henry. Now, as we work towards these big plans and big goals, there are tax implications every step of the way. And taxes are a significant liability, but we assure you there are a world of opportunities to take advantage of the Income Tax Act and minimize those taxes. Now, with all that said, it is crucial to start thinking about these tax concerns and tax considerations right now so we can fully prepare with you for the future. So, with that in mind, we have developed a comprehensive tax plan. We want to explore it in 3 different sections. First, we want to talk about what needs to happen relatively soon. So now, the most important thing, of course, is you handing off the business to Henry. So the most important thing is to keep in mind the business valuation, which we will walk through. And then secondly, we want to talk about succession planning in terms of implementing an estate freeze and also perhaps introducing a trust. Next, we're going to talk about, once we have that corporate structure all set up, we want to talk about compensation and also partnership. You had some big questions surrounding what the compensation is going to look like during that transition period, so we want to assure you of that. And also, partnership is one of the big opportunities that you have. And lastly, we care a lot about your family, your well-being, and your health. So we definitely want to take time to talk about personal planning and retirement planning for both of you, Susan and Henry. So Pat, myself, and William will be exploring these areas respectively. So to start off, Patricia will head right into business valuation and succession planning.
So the first thing that we have to look at within the corporate issues is, of course, the valuation of Miel Inc. And then we will be moving on to the impact of Richard shares that he holds and how we'll kind of move him out of the business first before we bring in Henry and consider the different options each step along the way. So to begin with valuating the business, obviously there's many different things to take into consideration here. It's really important to understand that with the Lloyd's Corporation, the customer relationships are really important, and so we feel that everyone needs to kind of judge this on their own basis, but we just want to make sure that we show you exactly how the different numbers compare coming from every direction. So Henry, you have an idea that you think in your head it's worth about $500,000. Richard, based on asking $150,000 for his 25% share, puts it a little over that, but there is an offer from a competitor for $1.9 million, which is a bit more in line with, Susan, what you think it is worth, and so we really feel that this is the number we'll be working with as we go along the way. But Henry, there are some different methods to evaluating the business that we've given you some information on that it's important that you look into considering if you don't feel that the $1.9 million, which is an arm's length transfer that is a good number for us to kind of work with, is not right for you. So moving on to there, we want to just show you your current corporate structure, which involves the holding company that, Susan, you've purchased your shares through, and then Richard, purchased the 25% through by yourself. So with this, we want to split up the $1.9 million based on the 75% and 25%, just to show how it really looks. Next, we want to talk about the capital gains exemption, which is something that we're going to continue to bring up. So we just want to really make sure this is kind of well understood. So this is $800,000 of capital gains that can be received tax-free on the sale of shares of a qualified small business corporation. So Miel Inc. currently qualifies for this, so this is important to take into consideration kind of as we move through this corporate plan. And Susan, you've already realized some of this when you first sold the 25% of your shares to Richard to begin with, so we want to make sure that that's identified. But now to move into the impact of Richard's shares and how you purchasing them for $150,000 could potentially affect this capital gains exemption that you'll be able to apply to the overall sale. So if we remove Richard's shares for $150,000, the adjusted cost base will only go up to $175,000 instead of the $475 fair market value that we're working with right now. So then this is $325,000 difference, which amounts to a quite significant amount of tax that then you'll be realizing, and you will not be able to see the capital gains exemption because there's such a great fair market value difference. Whereas if Richard was to take on some more of this capital gain, you wouldn't have to realize this in the future on your estate freeze. So we just want to identify that. Although you're married to Richard and you will probably want to discuss on how this transfer is the best for you, it's $76,000 of tax that can be prevented if you kind of adjust the amount that you're paying specifically to him, depending on what capital gains exemption he's used in the past. So that's the first step, is to purchase Richard's shares. So we'll be using the $150,000 purchase price that you've talked about before, just as a conservative base, but there is an opportunity there to take advantage of that capital gains exemption if he hasn't used it up. Now the tax on your capital gain, whether you're to sell it right now to your competitor or to crystallize and pass it down to Henry, will be the same using this $1.9 million valuation. So applying your remaining capital gains exemption at $750,000 will leave you with $975,000 of capital gains to be taxed, and then overall taking the $1.9 million, you'll have about $1.6 million after tax cash. So just to give you a kind of a general number going forward as we work through to have in your head. Now, moving on to considering what would happen as far as bringing Henry in. So that would be the after-tax cash if you were to sell right now to your competitor. So that's the option you have right now. But the different things that you've talked about as far as bringing Henry into the business, the things that you guys have identified is the personal loan. So Susan, this would be set up by you if you were wanting to completely cut all ties right away to the company and bring Henry in. Then you could give him the personal loan for $1.9 million or whatever you deem to be the fair market value, and then he would purchase all of your shares, and then he would have to pay you prescribed interest at the prescribed rate of 1%. Otherwise, that would be interest attributable to you for that loan. But another option that we've identified is an estate freeze, and in this way, Henry can join the business and see the growth of the business for what he contributes. You'll still be able to maintain control, and we think that this is it's a more complicated transaction, but it's really something valuable that we want to work through with you. So we're going to kind of go through these extended steps, although the personal loan option is still there. So the value of an estate freeze really allows Henry to come in at a nominal amount. So we'll be locking in the growth of your current common shares for preferred shares, and then he'll be able to buy in for a minimal $100 or $1,000. We know that he wants to pay something to you, Susan, that is fair for the transaction, but this way you'll be able to take out the fair market value of your common shares with redeemable and retractable preferred shares. So you can swap these under a Section 85(1) rollover on a share-for-share transaction, which will happen tax-free, and you'll be taking back preferred shares, redeemable and retractable at the fair market value. We'll be electing that these preferred shares are voting shares so that you are able to maintain control, and whether you want Henry to be given voting or non-voting shares is up to you. If you think that the growth that he'll receive in these next 10 years before you're not a part of the business is going to surpass your $1.9 million of value, then it's important to recognize that he could see the control of the company, and we want to make sure that's taken care of. And then you'll be able to take out the value over time, so you'll be able to redeem this money out of the company kind of as you see fit and as you need the cash. So ultimately, this is what it'll look like. You'll be rolling over your common shares for preferred shares, and here we want to make sure that you elect for a price adjustment clause so that the CRA doesn't deem any excess fair market value to be attributable to you, and then you'll be able to recognize that any adjustment that they seem to find. And then Henry will be able to buy in at a nominal amount. So here we just have $100 for an example. Now we also want to talk about the introduction of a trust for Henry in particular. trust. At the same time, it'll be really good because he'll be able to get in at a nominal amount. So at the time of the freeze is really the time to do this. And then the benefit is that it'll be able to multiply the capital gains exemption for Henry if you so choose to sell this business later on in the future. So you'll be able to elect your wife and your 2 children as beneficiaries of the trust, and then as long as the kids are old enough, the sale of shares will be able to multiply that $800,000 on any future growth. Because these will be common shares, they will be attributable to the trust. It's important to note that the non-lawyers will not be able to receive any dividends, so although trusts are a good opportunity for some income splitting, Jennifer won't be able to see any of those dividends, and as the girls are so young, they as well, of course, will be they'll have to watch out for the kitty tax. Now, this will be a discretionary trust that we'll set up. It'll have a 21-year life, and then Henry, you can be set up as a trustee so that you can be determining what dividends need to be paid out and need to be flowed through. So next steps, although this is a lot coming at you with the corporate, there's a lot of decisions to make along the way, and a lot of them have to do with different relationships you have. So we really feel that you need to take a step back, reevaluate this information that we've given to you, and kind of see what works best for all of your families that are involved. So the first thing is evaluate between the buyers. Of course, you have the competitor across the street, which is giving you the $1.9 million right off the bat. Or setting up the estate freeze and going through Henry, seeing if there's another fair market value that you can determine. And then we need to make sure that you decide how much to be purchasing Richard's shares for. And then, of course, if we're going through with the estate freeze and bringing in Richard, we need to perform the estate freeze and then potentially introduce the trust for him. So we've gone through a lot of the corporate issues, the valuation of the company and the succession planning for Richard. Now we want to talk about the compensation and potential managing issues that Henry, you've brought to our attention.
So just to give a quick overview of what this section is going to look like, we're going to talk about the compensation during the transition period, which was one of your biggest concerns, Henry. And also we wanted to outline some concerns in terms of any trouble you might run into becoming a personal service business, which we will explain about further. And lastly, we wanted to identify this opportunity for partnership and also share our insights on what that opportunity is going to look like in your case. So to start off, we want to make sure everyone's on the same page in terms of salary and compensation. So Henry, you're expecting $150,000, and Susan, you currently earn a salary of $225,000. So what we see is that if you keep paying both these wages, it's not very sustainable for the company. And as well, Susan, you will be taking a step back, and it must be reasonable what you're getting paid from the company in the eyes of the CRA. So the main takeaway is that, Susan, you will be taking a smaller salary as you go through, and Henry, you will be earning $150,000 because that is very reasonable for a lawyer in your case. And next, we want to talk about other compensation issues. Now, the CRA has some concerns in terms of, independent contractors going to incorporate themselves and then taking that lower tax rate just because they can. So the idea of a personal service business is if someone like you, like a lawyer, were to incorporate themselves, they would have a lower tax rate. And the guideline for that is if you have 5 full-time employees and 1 part-time employee, then you're off the hook, then you're safe. So to take this back to the case, there are a lot of employees coming in and out as you go through this transition period and as you work towards handing off the business. What we want to make sure is that you're keeping an eye out and maintaining 5 full-time employees and 1 part-time employee. So one way to do this is to hire Jennifer in. So Brianna is 5 years old now, she's getting ready for preschool, so Jennifer can definitely join the business. So what we see this as an opportunity is for her to come to the business on a part-time basis, get paid a reasonable salary, and then also fit into that guideline of 5 full-time employees and 1 part-time. And lastly, we do want to outline this opportunity to income split, which we're not doing right now, even with Jennifer in, but if Henry, you choose to take a lower salary in the future because of Jennifer's involvement in the corporation, then that is definitely an option. So next we want to talk about the opportunity of a partnership. So right now you are in incorporation, and we do think that this is the appropriate state for you to be in, but there is an opportunity to bring in a partnership because you had some concerns about a backup plan. What if it's all a little overwhelming? So this is what we've come up in terms of a backup plan. It will allow you to bring in another person, and they can share their expertise and their clients, and it also gives you a little more time with your family and alleviate the workload, which we know is very important to you. Now, just to compare the two, so if we're going from the incorporation to the partnership, as a corporation, you're taxed as a separate entity, and you can defer income taxes through a surplus, you have limited liability, and dividends can only be paid to the lawyer. Now, these are all characteristics of an incorporation which you're benefiting from right now. And from a partnership, you're taxed at a personal level as business income, and this allows a partner to also assume some risk and some workload, but it is important to note that you do lose limited liability, so you will be personally liable for any risk that the lawyer business may come into. And the thing to take away from this is also that dividends are payable to partners, which alleviates you from that restriction of dividends being only paid to lawyers. So we have some thoughts on this as well. We think that keeping Melee Inc. as a incorporation is the correct answer because leadership is the main concern here. If you're scared that you might not be able to handle the workload, Henry, you have Susan to guide you to the business, and no doubt you're going to do a great job. So we don't see leadership being a huge problem for both of you because we know that you can handle the transition very effectively. And lastly, we know how important the business is to you. You want to keep it in the family for sure, so it might dilute the brand as well of the business. And lastly, we do not see any significant or immediate tax benefits as of right now, but this is definitely an opportunity you want to keep in mind in the future if you want to keep expanding and growing the business. So just the next steps is to establish a transitional compensation. So really work out those details, make sure everyone's on the same page and there's nothing to fight over about. And lastly, we want to make sure that you're adhering to the guidelines in terms of employees that you must have to avoid being a personal service business. And lastly, we're going to evaluate continually the need for a partnership as we go through and work with you in your future tax planning as well. So lastly, we're going to talk about what's most important to you, and it's your family.
So we've talked a lot about the Melee Inc. and the corporate structure around your lawyer's firm. But now it's time to talk about the Melee family itself. So first we're going to go through a little bit of a plan for you, Henry, based on retirement and planning with your children. And then for Susan, we want to look at your retirement income and the insurance concerns that you outlined to us. So we're going to be talking a lot about RSPs and TFSAs throughout this section, so I just wanted to provide you a quick rationale, a quick difference between the two of these tax-shielded savings accounts offered by the federal government. And when you get down to it, this is the choice that you need to make. If your marginal tax rate is currently higher than it will be in the future, so that's an example for you, Susan, you want to look at contributing to your RRSP. Well, if your current marginal tax rate is lower than it will be in the future, which is you, Henry, you want to look at a TFSA. So priorities for Henry. Pay off the credit card debt. It is the best investment you can make. Not much investments in the real world will give you around 20% return. Next, look at opening up a TFSA. You already have an RSP. TFSA is a great way to save right now, especially with you have a lower tax rate at the moment, and if you move into Melee Inc., you're going to have a higher marginal tax rate. So planning for the family. For your two daughters, an RESP is a great way to pass wealth down at a tax shielded rate for your children. There's a lot of opportunities. There's a lifetime contribution limit, but if you contribute annually, you will be eligible for a maximum of $500 per year from the federal government of free cash, pretty much, to save for post-secondary school education. As well, take advantage of increases in the arts and fitness tax credits offered by the federal government starting this year. So just a few other concerns. Shares and CCPCs should not be held in your RRSP, just in case you had any questions about that. As well, we can look at some income splitting opportunities with Jennifer through spousal RRSP contributions for income splitting in retirement, or through spousal investment loan if she wants to start an RRSP as well, as long as you charge the prescribed rate. The income from those investments will not be attributed back to you. As well, if you do move out to St. John, there'll be some moving expenses, and we'd love to work with you in the future to make sure that you do not experience any increased tax liability on those. So, Susan, your retirement. You want to make sure that you had between $100,000 and $125,000 per year in retirement. We looked at about 30 years of retirement and on average $112,000. So that a basic present value over those 30 years is around $1.3 million, and you've more than enough wealth distributed throughout. This is all pre-tax numbers, since we've assumed that the income that you want is pre-tax as well. So you also had rental properties. We want to remind you that it's best to make, if those are held in the holding company along with the Melee shares, it's best to incorporate those to protect those shares from legal liability in the future. And then if there is a disposal, there will be no primary residence, potential for primary residence exemption as they're held at the corporate level and you are not currently residing in those two rental properties. And then you mentioned some insurance concerns. We outlined some disability insurance that we'd like to work with you in the future to make sure that what you have right now covers it enough. And as well, life insurance is a great way to protect against future tax liabilities. So just some other considerations we want to go in is the medical expenses. Those are deductibles and we can work through a plan of building the right medical expense year to claim and get the most benefit out of those tax credits. Potential for a trust upon death to make sure that we can operate under Section 76 rollover to the spouse if one spouse is still alive at that point. And then contributing to the grandchildren's RESP is a great way to pass wealth down to the next generation. So today we talked about a lot of things, and it's time for us to work with you, work through this tax plan to make sure that Melee Inc. will grow and operate in a tax advantaged way, benefiting the entire community of St. John for years to come. So now, if you have any questions of what we proposed today, we'd open the floor to what you have to ask.
I have a question regarding the alternatives. You provided us with the alternative of selling the company externally or else selling to Henry. Can you provide a recommendation to us all?
I think with your values of family, that really succession planning is kind of the most important thing that we'd like to identify. I think that if Henry wants to get into the business and move out to St. John's and see that lifestyle, that's a really good option for him as well as for you to be able to perform that estate freeze and bring him in at a nominal amount at this time.
Did you have an opportunity to look at, you mentioned that Susan and Henry have RSPs and look at TFSAs, but did you have an opportunity to look at the mix of investments and determine whether those were appropriate?
So we didn't have much information of what was held in terms of a growth rate in Henry's RSPs. Currently, oil and gas might be a bit of a question mark to be holding, but hopefully that will turn around the next year or so. But we were holding in Susan's account, there was some mutual funds, but the 90% of it was in quite low growth investments. We should look at potentially looking at some alternatives above that 0.5%. With inflation the way it is, you could be technically losing money if they're performing overall at that estimated amount. So that's something we'd love to work with you in the future.
What kind of risks to this business are there in Henry taking over, just from his personality or his experience?
Yeah, definitely. I think risks, especially as far as taking over a client service business, is really important. As Richard brought in a lot of clients from his experience into Susan's business, and now with Richard selling his shares immediately and then Susan kind of backing off over time, that it's possible that he might be losing clients at an extremely high rate, higher than he perhaps perceived. So that's why we've kind of worked with the backup plan and focused on alternatives to bring in other managers, and he can work more with bringing in his clients from Northern Ontario.
All right, thank you.
Thank you.
Thank you very much.